Hey everybody, welcome back. Guess what we're going to talk about today? That's right, a live earnings preview here for Southwest Airlines, ticker LUV. Good stuff going on here at Zacks. Hey everybody, Dave Bartosiak. So glad to have you back again. This is like the third one we've done this week, but we're going to keep on rocking. And this isn't going to be the last one we do this week because tomorrow we've got Chipotle. So make sure you tune in for that. But first and foremost, we're talking about Southwest Airlines. Very popular, sort of, I don't know if I guess you call them a discount air carrier here in the U.S., although they're not, you know, all that nickel and diming stuff that you typically associate with a discount air, Spirit. You don't have that, right? You get to pick your own seat. You know, everybody's all smiley. It's nice and cushy over there. Here in Chicago, you got to fly out of Midway, which is great because you don't get as much frustration as you do at O'Hare, but it is what it is. So just like we kick off all of these shows, let's take a look at Zacks.com and our price, consensus, and EPS surprise chart. Per usual, the black line is the price. That's right here on the right y-axis. And then on the left side, left axis, we have actual EPS numbers. If you notice these different colored lines here, this is the evolution of our Zacks consensus estimate over time. Fancy stuff. So you can see the 2013 numbers, how they evolved. 2014, 2015, this is when things got nuclear. I mean, look at this big jump. And then now we've got all sorts of madness taking place over in here. What's going on here, Southwest? You know, rather than having these great growth numbers that you had year over year and earnings estimates that would start off kind of low and then start to tick higher, now we're kind of bouncing all over the place. I know we've got all sorts of external factors here, right? You've had global terrorism events that are definitely scaring some people off. Shouldn't matter too much to Southwest, though, because they're a domestic carrier, right? Unless you're worried about those weirdos in Austin, I think you're going to be okay. Anyway, and then, of course, you've got, you know, oil prices and the moves that we've seen there. And I think part of the reason why Southwest did so well in the past is because they're fantastic oil hedges. Now that oil's come tumbling down, I think it's sort of leveled the playing field for the rest of the business. So that's kind of what we're looking at here. But let's go back to the charts, right? Back to the charts. Now these little arrows that we have here, those are EPS surprises. So a green arrow to the upside, that's a beat, right? So you got a beat here, a beat here. If you see a little red arrow down, that doesn't happen too often for Southwest. You have to go all the way back to the Q2 report of 2013 when you saw negative 2.5%. So they do a pretty good job of managing expectations here at Southwest, at least on the earnings sides of things. But look at this, though. I mean, this is the part where we're a little bit worried here. You beat last time, market didn't like it, right? Even when it beat the quarter before that, we still sold off a little bit, or I guess that's an inline, and sold off, and a small beat and go up. But look at this curving downward movement here on our consensus. That's telling us what? That we're getting negative earnings estimate revisions here on Southwest Airlines. Don't want to see that. And again, remember, what we do here at Zacks is we go ahead and we look at what the analysts are estimating for the current quarter, for next quarter, for the current year, and next year. Then we decide based on those estimates, are they going down, are they going up, what magnitude are they going up, how many of these guys are agreeing with each other, and how the surprise has been in the past. So we take a look at all that, we aggregate it, and then that's where we give our Zacks rank, right? So it's not just us sitting here thinking about it going, 5. No, it's an aggregate of all the data based on historical back testing we've done for years. So this is the Zacks rank number 5 strong sell right now. So you got to keep that in mind. I don't want to sway you too much on Southwest. I'm just looking at charts here, man. Lines on charts and telling you how it is. So again, price, consensus, EPS surprise chart right now, not looking fantastic for Southwest. But let's dig a little deeper into this and take a look at our detailed estimates page on Zacks.com. So under the detailed estimates, scroll down here a little bit. here's where you can see the Zacks consensus estimate and how it's evolved here over time. So if you look at the current quarter, 90 days ago, analysts were looking for a $1.27. Now we're looking for a $1.22. Next quarter's numbers look smaller, right? From a $1.13 down to a buck. If you look at the year as a whole, we're dropping down from 430 to 407. If you're looking at next year's numbers, 455 down to 433. And who did this? Who did it? 4 analysts in the last 30 days have downgraded their estimates for the current quarter and next quarter. 5 have followed suit for the current year, while 3 have done so for next year. Now, I was digging into my top G14 classified reports that I get here at Zacks. Nothing fancy, you know, just, you know, major firms on Wall Street telling me what they think about the stock. So I was digging through here, and here's something to watch that one analyst noted, okay? So they're expecting to see revenue per seat mile, which is kind of almost a measure of efficiency in the airline business. They're expecting that guidance for the third quarter to be negative as the company faces a 200 bip headwind from annualizing its credit card agreement last year. Now, I've had a few headwinds from annualizing credit card agreements, so I understand. But essentially what it means is that you're going to see a little bit of a compression there. So, I mean, you can think of it in terms of like a margin kind of thing, right? So they're not going to make as much money as on a scale. Like the scale's not going to be as good as it was before at the margin, essentially. It's kind of what we're talking about. So that's part of the reason why this analyst in particular has gone ahead and tick down those expectations a notch. But they did make sure to note, like I said before, again, Southwest, domestic airlines. So you don't really have to worry about the impact of Brexit. And while, of course, there is some collateral sort of worry overall in the airline industry about kind of the global terrorism thing and what we've seen, it's not going to make as direct of an impact as it would on, you know, other places of the world. So they're not flying to Turkey or anything like that. So they're not worried about the coups at the Southwest Airlines. All right, now, again, I'm going to give you a couple of trade ideas here. First, we're going to look at a bullish trade idea. So if you think that Southwest is going to kill it and they're going to do well, I'm going to give you a way to play that, right? But I'm also going to give you a bearish trade. So if you think that this thing is going to fall apart, I'm going to give you an idea on how to make money that way. And then I'm going to go ahead and offer up what my personal opinion is. Now, you don't have to agree with my personal opinion. And if you don't agree, I'd love to hear it. Chime in the comment section below. Tell me all about it, why you disagree. Again, this is a discussion. I'm not here to judge. I'm not going to yell at you and call you silly, although people say much worse things to me. But that's okay. We just delete them and pretend like they never existed. So don't be mean, because you do get deleted. All right. So now let's take a look at the live options chain here. Back to the charts, back to the computer. So the way that I do this, all right, I go to Yahoo Finance, type in the ticker, gives me an option that's going to expire on Friday, right? It's all about the weeklies nowadays. But I'm going to switch this to the straddle view. That way, I'm going to get the call options on the left side and the put options on the right side. Now, if you remember back to your Options 101 training, calls are basically bets that the stock is going to go up, and puts, you're betting that the stock is going to go down. So I like to use these in order to come up with an idea of what the market is expecting in terms of the move here. So if you look at the at-the-money call option, 85 cents, 85. We're going to add that to the cost of the at-the-money put option, 80. So you get $1.65 there, divided by the 42.50. That's a 3.8% expected move in terms of shares of Southwest Airlines. Now remember, when we were looking at the price consensus and EPS surprise chart, you saw some of these moves were actually pretty pronounced in the period immediately following the earnings report for Southwest Airlines. But what I'm even more interested in is catching this sort of post-earnings drift. Was that a catch my drift pun I just did? Yeah, I could have. The post-earnings drift is what we're looking for. So that's basically when people read the report, they digest it, they let it marinate, and then they're starting to buy it. Big-time money managers are adding to positions, and retail guys like you and me are pulling the trigger or dumping the thing in the hopes that it goes down. So post-earnings drift is the name of the game, and that's what we're trying to get when we're on the long side of these options. I think that's what I'm going to put together here, because as I was looking at this options chart, this options chain that is, the further out options really aren't all that pricey. So with a 3.8% kind of implied move here, I don't really believe that there's enough premium for me to just sell premium and kind of sit back here on shares of Southwest. Also, you know, the market's been kind of exacerbating moves recently, so I think I want to go back to finding some real nice trades that could potentially pay off big time for you guys. So that's what I'm going to do here. So first, let's look at the bulls. So we're going to have to go back to this, and we're going to have to change this from July 22nd. Let's go to the August contract, right? Because then at least you'll let it run a little bit. You have a little bit of time for that post-earnings drift to go ahead and kick in. So remember, at the money, we're talking 42.50, right? So here, this 42.50 call is going for $1.46. Hasn't been a lot of volume here, though. Only 34 contracts have traded. The open interest is like 10. Ugh, right? Not a lot of volume there. Not a lot of volume. So I think what that's going to do is going to force my hand a little bit. So I'm going to go a little further in the money. And I'm going to buy the 42s because I just like that there's 1,800 contracts here, more liquidity, right? That liquidity is important when you're trying to sell out of these things because you don't want to be locked inside of an option that's got 10 contracts of open interest when you've got 10 contracts, right? It's not a good situation to be in, okay? We really want to get a nice big chunk of open interest. That way we know there's people with some skin in the game that are willing to buy and sell that contract so you're not standing alone on an island somewhere, right? It's not good. It's not a good look for when you're trading options. Unless you are trading options from an island, but that's another thing. All right, so I'm going to go long the 42. That's going to cost me $1.80. But I don't want to just be exposed just to all that risk, right? So by buying this at $1.80, I make every single dollar above, you know, every penny above 43.80, I would make $1 on this trade, right? Pretty much unlimited all the way up. So if it goes to 100, I make a ton of money. But I don't really think it's going to do that. Remember, these options were only pricing in, or at least at the money for the week of the week that they report, which expires on Friday. Only looking for 3.8%. So it was like $1.60. So from where we are, that puts us at like 44, right? I think it could run up a little bit more than that. And you got kind of the psychological resistance at the $45 level. So I'm actually way more comfortable with this. So what I'd be looking to do here, if I were a bull, I would go ahead and I would buy that $42 contract. It's going to cost me $1.80, right? Then I would sell the 45s at 58 cents. So that's going to cost me $1.22. Now, my upside potential on this trade, though, that's where the fun part comes in, because your upside potential is the difference between the strike prices. In this case, $3 holler. So you're going to spend $1.22. You could potentially make $3. So that's $1.78 of profits that you can make on your 122. So let's go ahead and do that math. So 178 divided by 122, upside potential is 145%. In like a month and a half? That's fantastic. Now, what would have to happen for that to happen? You would have to have the stock close above $45 at expiration. Now, that does seem a ways off here, but again, I told you we were going to be bullish. But how do you break even on this? You got to take that $1.22 that I'm going to spend on this call option and add it to the $42 where I ended up loading the boat on the long side of the call. So then that's 43.22. So the stock only has to close above 43.22 for me to break even. And that's at expiration August 19th. Where was the stock trading at today? That's up here at the top of the list. 42.50 basically on the dot. So that's not much of a move. You're talking a 70-cent move. Let's go ahead and calculate that up. 70 cents on 42.50? It's only a 1.6% move. That's only half of kind of this implied move that we're getting based on the at-the-money options that are going to expire on Friday. So that's good stuff. So there's the call. But we got to talk about the put side here. I'm going to put on a put spread the same sort of way. So here I'm looking. It's going to be the contract that expires August 19th, sorry. Now, look at this. Who's down here at 40? There's 15,824 contracts of open interest at $40. Who on earth is at 40? It makes you kind of want to have a little skin in the game down at 40, right? So I think with the stock at 42.50, perhaps 40 will be the bottom end of my put spread that I'm putting on, right? So I think I'm definitely going to be selling those. I'm going to sell a little bit of those. So that's 59 cents there. But I want to go long. Honestly, I would like to go long at this 42.50 here. But again, not a lot of volume, not a lot of open interest. But here we go. We got 86 contracts of open interest. So there's a little bit more here. But I'm also going to get in the money a little bit. I'm comfortable with this. So I think what I'm going to do, am I comfortable with that? Yeah, I'm comfortable with that. Okay. So this is what I'm going to do. I'm going to buy the 43 puts. It's going to cost me $172. I'm going to sell where everybody and their mamas has bought a put option down at $40. I'm going to sell that. So this trade is going to cost me $1.13 to put on. My potential upside on this trade, again, still the difference in the strike prices. So I bought the 43. I sold the 40s. That's $3. A $3 holler on this one too. So take the 3 minus the $1.13 that I paid for it, right? So that's $1.87 of potential. So 187. That's 165% potential rate of return. What has to happen for that? I'm going to need to see Southwest Airlines close below $40 per share at expiration on August 19th, and I will maximize my profits. Now, where am I going to break even on this? That's going to be that 113 subtracted from that 43. So that's 41.87. I just did that. 41.87. So as long as the stock closes below 41.87 at expiration, I'm going to be okay. So let's go ahead and do this math for you guys real quick. So 43 minus the 41.87, that's that $1.13 I was talking about before, right? Okay. Now divide that. That's how much it's got to move. Divide that by the 42.50. So 2.6% rate of return is all I need to break even on this. And again, 3.8% is what that was pricing in here anyway. So, which one would I choose? Now again, remember, Zach's rank number 5, strong sell. We've got a note out of an analyst basically saying that they're going to see some contraction in that RASM number coming up next quarter. 200 bips of headwind from their credit situation they got going on. That, I think, all in all, is enough for me to lean a little towards the bearish side of the equation here. So personally, I'm going to be putting on that 43.40 put spread expiring August 19th. It's going to cost me $1.13, and I'll have all that wonderful upside potential. Again, thank you guys so much for coming out, hanging out with me here again today. We're going to be doing this all over again tomorrow. So come back and hang out. We're going to be talking about Chipotle, and if you dare me, I'll eat an entire burrito while I'm doing it. Nah, I'm lying. Maybe I'll eat a burrito before. Well, actually, it's probably safer to do it after, given the situation at Chipotle. But we're going to be talking Chipotle tomorrow. Again, it's going to be here 1 o'clock live with Dave Bartosiak here on Zacks.com. I'll see you guys then.